Thank you for downloading this Council on Foreign Relations video. CFR is an independent national membership organization and nonpartisan research center. For more information, please visit us online at cfr.org.
Today's council meeting is part of the McKinsey Executive Roundtable Series in International Economics, co-sponsored by the Council's Maurice R. Greenberg Center for Geoeconomic Studies and the Corporate Program. A few housekeeping announcements to start. As usual, please completely turn off your cell phones and BlackBerries. Don't leave them on vibrate because it interferes with the sound system. And I'd like to remind everyone that this morning's meeting is on the record. We've got a very distinguished panel of economists, historians, and economic historians here this morning to address the topic of crisis and capitalism. Does history suggest where we're headed? From my left, Michael Bordo, professor of economics at Rutgers University. Jerry Muller, professor of history at Catholic University of America. Robert Shiller, Arthur M. Oken, professor of economics at Yale University. And Richard Silla, Henry Kaufman, professor of the history of financial institutions and markets at New York University. Gentlemen, over the past year and a half, we've seen a mortgage crisis morph into a full-blown financial crisis, and now apparently we're headed into a full-blown economic crisis. The economy appears to be shrinking rapidly, unemployment's rising rapidly. Against this backdrop, many commentators are looking for useful historical parallels. And what I'd like to do in the first 40 minutes or so before we open up to audience participation is to get your perspectives in two areas in particular. First of all, are there useful historical parallels in terms of telling us what we should be doing as a policy matter to get ourselves out of this crisis? And secondly, many influential commentators are predicting, and many indeed calling for, very robust permanent interventions in the financial markets, a lot more government control to ensure that this type of crisis doesn't develop again. Again, does history offer us any lessons as to what we're in for in terms of increased government intervention and indeed control in the financial markets? And what are your thoughts about whether these developments will be positive or negative? Michael, let me start with you. Many commentators, as you know, like to focus on the 1930s in particular in terms of looking for historical parallels, but I know that you think there are useful lessons even to be learned from much earlier periods in the 19th century. So I'd like to get your thoughts to start.
Yes, the U.S. has had many financial crises since the beginning, since 1792, and some of them have been very serious. And I think the kind of lessons we can learn from the big crises of the past is that, in a sense, they were like today. They were events that led to serious economic consequences. They were often nasty. They led to significant wealth losses. They often were associated with recessions, which led to declines in output. Okay, but there was another side to the story that I like to emphasize, which is they were, in some sense, learning experiences for institutional reform. And there were three or four instances, which I'll just mention briefly, leading up to the 1930s, which I think are relevant. One was the free banking era from 1837 to 1863. The second was the national banking era from 1863 to 1913, and then the last is the Great Depression era. And in each of those cases, you had a regime in place which was in a sense established in response to a crisis, and the regime in a sense had its own defects, which sponsored another crisis. And then we learned something, and in each case it was kind of, we went 2 steps forward, but we often went 1 step backwards. So the free banking era came out of Andrew Jackson's veto of the charter of the Second Bank of the United States, and this led to banking being completely unregulated by the federal government, but regulated by the states. And the regime that was established, where you had virtually free entry into banking, you know, and it's had the good effects of allowing banks to proliferate across the country, but there were some problems with it. One was that there was a proliferation. There were no restrictions on banknote issue, and there was a proliferation of state banknotes, which circulated at varying discounts, and so the means of payment, okay, was very unstable. And also there were many bank failures and about 4 or 5 financial crises. And this led to a major reform, since the problems of the national banking era of the free banking era led to a major reform, which led to the national banking system established during the Civil War. And the national banking system created a uniform national currency which was backed by U.S. government bonds. So it solved the problem of the proliferation of banknotes, but it didn't solve the problem of financial crises, which was the fact that people would tend to run on their banks and convert their deposits into currency if they were worried about the stability of their banks. And this would lead to a banking panic, which, in a sense, unless there was a lender of last resort handy, unless there was a lender of last resort available, would lead to a serious economic crisis. And there was no effective lender of last resort in the national banking era. There were a couple of sort of alternatives. There was the U.S. The clearinghouse loan certificates, and the U.S. Treasury on occasion acted as lender of last resort, but it usually didn't work. And so this led to a major reform. Okay, the reform occurred after there were 3 big crises in the national banking era. Okay, 1873, 1893, and 1907. 1907 was the straw that broke the camel's back. Okay, in part that was because the crisis was partly resolved with the aid of J.P. Morgan. Okay, and in reaction to the fact that a private individual, okay, who seemingly had a lot of economic power, had to save the United States. This led to the reforms that occurred in 1908. The Aldrich-Vreeland Act, which issued a national reserve currency, which instituted a national reserve currency, and led to the National Monetary Commission. The National Monetary Commission, which deliberated for 4 years, okay, came out recommending a central bank for the United States, which would have the features of the Federal Reserve System. And so, in a sense, we had two regimes which had crises. The crises led to institutional reform. Okay, now we know, getting to the last one, to the Federal Reserve System, okay, it was successful for 15 years in maintaining stability, but then it failed miserably between 1930 to 33 in stemming 4 serious banking panics, okay? And the reaction to that was to blame. The reaction to the Great Contraction was for Roosevelt and the New Deal to blame the central bank and the bankers and to institute major regulation. Okay, this led to FDIC, which in a sense did solve the problem of banking panics because it removed the incentive for people to run on their banks. It led to Glass-Steagall, which separated investment from commercial banking. Okay, it led to a host of regulations on the banking system, and it led to the Fed being subsumed under the power of the Treasury, and this obtained until 1951. So there was a major sort of heavy regulation of the financial system which came out of the Great Depression, okay, and it did succeed, okay, for approximately right up until the 1970s. It did succeed in providing financial stability, but it did so at the expense of stifling financial innovation. Okay, and there's this apocryphal story that I might have heard from my colleague Dick Silla or others about the banker, typical banker in this period in the 1950s, who would, show up at the bank at 10, make a few loans, have a 2-martini lunch, okay, and then retire to the golf links at 3 o'clock. So that's the environment that came out of, that is said to have come out of the Great Depression era. But everything was predicated on monetary stability. And that was delivered by the Federal Reserve in what was called the Bretton Woods era, Okay, and it lasted until the 1960s. But once the pressures for inflation grew in the 60s, okay, and led to what's called the Great Inflation, okay, then the controls that were set up on the banking system and the financial system, ceilings on interest payments, a prohibition of interest on demand deposits, et cetera, and firewalls between different types of financial functions. Okay, once the Great Inflation got going, the pressures to evade the distortions that were being caused by the inflation, okay, led to this S&L crisis and the breakdown of the regulation and to the regime that we're now in. Okay, the regime which is now, in a sense, under threat. Okay, I'm not getting into the reason for the financial crisis, but the last thing I want to say is that I'm worried. I'm worried that what we're going to get out of this is some overkill, regulatory overkill, because the government, the Treasury, the Federal Reserve, okay, have done massive intervention, created many facilities. There's going to be a large fiscal stimulus package, and all these things are going to do what they should do. They're going to help the capitalist system, in a sense, rebound. But what I'm worried about is that now we're going to have this large panoply of controls and an increase in the government in government's role in the economy, which might take a long time to roll back. And I think the cautionary tale from our own history in the 1950s, 40s, 50s, and 60s, and more so from that of Europe, okay, which went much farther than we did in nationalizing the banking system, nationalizing a lot of the financial system, and creating a much greater array of controls. Okay, the European case, okay, is a cautionary tale for us because it took them until the 90s, until about 1990, to roll it back. And when they did roll it back, the regulation, this led to a banking crisis, which was much worse than the one we've had today. Okay.
Michael, you've talked about the creation of the Federal Reserve System and its expansion. Over the course of this crisis, of course, the Federal Reserve has sort of unilaterally increased its powers very dramatically. If you go back only a year ago when the Fed's balance sheet was about a third the size of what it is now, Paul Volcker was questioning whether the Federal Reserve was in fact exceeding its statutory authorities. Flash forward, say perhaps 2010, we start emerging from this crisis. What will the Federal Reserve look like? What new powers that they have arrogated to themselves, for better or for worse, will remain a permanent part of the environment?
I'm not sure how much they're going to keep, but I suspect they'll keep some of these new facilities, these new discount window facilities they've established. They'll keep a lot of them, and I think that the debate which took place about 10 years ago when Greenspan was in about the Fed expanding its powers, that debate, in a sense, has been won de facto by what the Fed's done. But I think there'll be people that will start thinking about, well, wait a minute, the Fed really wasn't established to do these things. It was really established to protect the monetary system and the payment system. Okay, and I think it's moved beyond its original mandate. Okay, it's acting because of the crisis, and it sort of says we'll do anything to protect the monetary system, which means going beyond the original boundaries, which is money and payments, okay, to the non-bank financial institutions. And I think that debate's going to come up again, because in a sense they have exceeded their mandate, and it's not. I mean, it can be, everything they've done can be found in the Federal Reserve Act. Okay, they can justify it. So I'm not going to get into this legalistic stuff. But in a sense, their real purpose was not to control the entire U.S. financial system. That wasn't what the founders had in mind. And I think they've gone beyond their mandate, and there'll have to be some discussion about maybe rolling it back.
Dick, do you have any thoughts specifically on the powers of the Federal Reserve and perhaps the Treasury, which of course now has an ownership stake in some major financial institutions?
Well, I think that we're witnessing a whole new chapter in the history of central banking being created. For many years, the central banks were many decades really, were constrained by being part of a gold standard system or some kind of specie-based, commodity money-based system. And of course, with the collapse of the Bretton Woods system in 1971, all money has become fiat money. You know, John Law from France in 1720 was just 250 years ahead of his time. And now in the 1970s, we've really gotten to John Law. John Law was a Scotsman who took over the finances of France and tried to convert them to fiat money system. Since 1971, we're on a fiat money system, and that has really freed up the central bank to do these sort of wild things that we're witnessing that Mike referred to, you know, wondering whether they could really do it or not.
And of course, that was the result of a crisis in Bretton Woods.
Sure. I mean, the real problem is the world economy has increased, you know, 150 or 300 times since 500 years ago, and it's very hard to supply a growing economy with enough money if you have to dig it out of the ground and refine it and then bury it back in the ground in Fort Knox. It's kind of a silly system. And so we finally, you know, in the 1970s, we realized that John Law had a good idea in 1720, and now the Federal Reserve can expand however much it wants, you know. I mean, it's theoretically there's no limit to but what it's doing, I think, is an illustration of what are sometimes called Bagehot's rules, and that's that in a financial crisis, the lender of last resort should lend freely on good collateral, but they ought to do it at a penalty rate. Now, the variations we're seeing today is that they're lending freely on not so good collateral at a rate that's not exactly a penalty rate. That's what I mean is the new chapter in the history of central banking that's going on now. But this all sounds like it's sort of ominous, you know, we're getting into uncharted territory. I actually think that this crisis is like many of the crises, you know, going back 300 years outside the United States. The South Mississippi and South Sea bubbles in 1720 were just like this, and most of them are just like this. But what distinguishes one crisis from another is does somebody step up to the plate and take bold action? Michael mentioned that the first U.S. crisis was in 1792, and I bet you hardly anyone in the room knows there was a great financial crisis in 1792 because somebody stepped up to the plate and handled it very well. His name was Alexander Hamilton. It's all his fault. He created this modern financial system, which is prone to crisis, but he also created the national debt, which some call the national blessing, and which is now being expanded to get us out of the crisis. So, I mean, 1907, Michael mentioned, there was another example of bold leadership on the part of J.P. Morgan. If you study the 1820s, you realize that Nicholas Biddle, the president of the Second Bank of the United States, took bold actions. So, you know, one of the ways you get out of a crisis is bold action. I'm seeing it in this one. There's a lot of bold action there. We're kind of expressing our doubts about it. But since I teach a course on the history of financial crises, I can say most crises that are well handled exhibit some sort of bold action. Ones that aren't so well handled, like in the 1930s, Michael mentioned that. Basically, the Fed sat there while 8,000 or 9,000 banks failed, and only with Roosevelt, when the bottom had fallen out of the economy, did we start to get the bold actions that Michael referred to, our modern regulatory framework. So I think if you want to feel good about the present crisis, be happy that some of these bold actions are taking place. Imagine how things would be if the Fed had just sat there and let the crisis get worse and worse, or if the Treasury had just sat there. So I think we're seeing the bold actions. The same thing was true in the 1930s. Roosevelt's actions were bold, and all kinds of people had their doubts about it. That man in the White House, a traitor to his class. Probably he was drummed out of the Council on Foreign Relations if he was a member. But that was the sort of bold action that got us through it.
Bob, what are your thoughts about the 1930s? Commentators seem to be rapidly trying to relearn their Keynes and relook at FDR and what he did. What can we usefully learn from the 1930s, and what perhaps are the cautionary lessons as well?
Well, first of all, I think you mentioned Keynes. His 1936 book, The General Theory, was really the most important economic book of the 20th century. and it's being resurrected now. It's been thought to be in disrepute by academic economists. And we've seen academic economics move toward what they call dynamic stochastic general equilibrium models. I don't know if all of you know what I'm talking about, or real business cycle models.
Even Gordon Brown referred to that 10 years ago. I don't think he makes reference to it anymore.
Edward Prescott won the Nobel Prize with Kydland for a theory that said that the only thing that drives the economy is technological progress. That's called real business. The cycle is really just the rational response of the economic system to shocks to technology. And that was interesting but wrong. And his Nobel Prize notwithstanding. But that's the way research works. You make some mistakes and you learn something from the experience. So we're coming back to Keynesian economics. The thing you have to realize is that in the 1930s, there was no established theory about fiscal stimulus. And so when Keynes wrote this book, it was very avant-garde. Now it's almost like a knee-jerk response. Everyone thinks that, well, Obama has to do a stimulus package. There's hardly anyone saying that there's something conceptually wrong with that idea. So I guess that was something that was a legacy of... That was a major change in economic thinking that occurred in the 1930s. One effect that it had, which is often overlooked, is that we developed our national income accounting at that time. And Keynes emphasized a breakdown of the national product into consumption, investment, government expenditure, exports, and imports. And then he had separate models for each of those components. That created an accounting system, and our system of every country in the world today is based on the Keynesian idea. So that's where we are now. The problem, I'm writing a book now with George Akerlof called Animal Spirits, which takes from a term that Keynes used in his general theory. We think that the Keynesian revolution hasn't been properly interpreted or understood, and that Keynes used the term animal spirits to refer to the sort of the inconstant part of human activity. Animal spirits means what moves you, what motivates you, what really motivates you. And Keynes said, in effect, that if people really took into account all of the uncertainties that we are faced with, we might be paralyzed into inaction because we just don't know the future. We never know the future. And anyone choosing an investment project is, for a company or for anything, is faced with fundamental lack of knowledge. Academics build these stories as if we know the probabilities. We have decision theory that we teach our MBAs. But in fact, you can't really do that because the decisions you're making are very much decisions that go forward for years or decades, and the world is changing, and how do you come up with probabilities? So somehow Keynes said that, well, the people there's this internal drive to do something, and it's an intuitive feeling about what's right and what. So one thing that we took from the general theory that is not often talked about is that it's these animal spirits, and it's this sense of, people call it confidence very loosely, but it's some willingness to go forward that can be damaged. And what I think was damaged in the Great Depression and is damaged now is the sense that this is a good time for anything. Right now, it's a bad time for everything. And so I'm exaggerating. Maybe you want to go back and get your MBA now. But actually, it's not a good time for that either because they're getting overcrowded, this MBA program. But that's what George Akerlof and I are arguing is that we only partially learned that lesson in the 30s. And what the fundamental problem that we see that's underlying the difficult situation we're in is that we've lost this confidence. There's just this all-pervasive sense of fear. It's what, in his inaugural address in 1933, Roosevelt said, the only thing we have to fear is fear itself. And then he said, we're struck by no plague of locusts. He was struck that there was no reason for the economy to be in this trouble. And incidentally, he bailed out the deposit insurance, ended the bank runs in 1933, but we didn't have a recovery from the recession until World War II. That's the only thing that got us out. So all these reforms didn't do it. And why didn't they? So George and I are thinking that it had something to do with this pervasive sense of trouble and uncertainty about what government regulations there'd be and what environment we're in. And everybody was on hold until the World War got us out of it. And this is a very hard thing for economists to model, and we argue that to think in different terms.
Let me push you further on this question of fiscal stimulus, because we're about to get a big one of some form or another. Keynes was never clear on exactly what the components of fiscal stimulus should be, whether it should be increased government spending, whether it should be tax cuts. Greg Mankiw had a piece in the New York Times arguing yesterday saying that, you look at the empirical evidence and at best it's ambiguous. Obama seems to be splitting the difference between the camp that says we should be focusing on government spending and the other camp, at least the other camp that supports fiscal stimulus, that says we should be focusing on tax cuts. Now, based on the evidence, the historical evidence, what do you think we should be doing?
Well, the thing about fiscal stimulus is that I view it as the ultimate thing is to restore confidence. And the problem is that it doesn't necessarily do that. And I don't think we have a real sure route to success. So we could stimulate the economy for a while, and then you withdraw the stimulus, and it just goes right back down. That's what Japan saw for ever since its bubble burst in the early 1990s. So I don't know that we have a secure understanding of, because it's really about driving confidence. We don't know. There's a tendency to view fiscal policy in very mechanical terms when it really should be viewed as in psychological terms. The other thing that George and I emphasize in our book is that on top of this problem of lack of confidence, related to it, we have a lending system that seems to be broken. And even though we've cut interest rates to zero at the short end, lending is not moving. So this is not just a matter of general mass psychology, it's getting those institutions working right. So some steps the government has taken have been very important. One of them, it's often forgotten that when Fannie and Freddie failed, the government put them in conservatorship and told them to keep on securitizing. That was a very important step, without which the real estate market would have collapsed even more strongly. So it's not just conventional fiscal and monetary policy that's needed, I think, now. It's also something to do with credit, making sure that credit is available.
Dick, do you have any thoughts specifically on this question of the role of fiscal policy in getting us out of a crisis? Does the 1930s hold any lessons for us?
Well, I think that I disagree with Bob slightly. I mean, there was some recovery in the 30s, but then there was a major, mistake made in the middle of the 1930s. The Federal Reserve has sort of been fingered as the agency that probably screwed up the most in the Great Depression era. So Americans, with our lighthearted approach to things, what do? We increase the powers of the Fed. And the Fed got the ability to vary reserve requirements in the Banking Act of 1935. And then the Fed looked at the banking system which, like today, was holding huge amounts of excess reserves. I agree with Bob 100% that the problem is really confidence, and bankers are shell-shocked now. And so they're holding huge amounts of excess reserves. They don't want to lend. Well, in the middle of the 1930s, the Fed looked at the bankers holding huge amounts of excess reserves and said, this might threaten inflation. And so what they did was they raised reserve requirements. And then the bankers said, gee, you took away a lot of our reserves now that we were holding because we were scared out of our minds. So the only thing to do now, and this was 1936, 37, when the Fed raised, sort of doubled the reserve requirements, the bankers immediately stopped lending, calling in loans, and said, they really wanted to hold those excess reserves. They felt comfortable with it. When the government took them away, they stopped lending again. So we got the recession in 1937, 38, which was a really bad one. And apart from, if that mistake hadn't been made, we might have had a little more recovery. But Bob's right in the sense the government didn't really spend enough money in the 1930s. I think that, this spending will help a little bit, and it'll help, whether it's tax cuts, increased spending, the recovery package will help some. I think Bob is right, though, that part of the effect is not just the mechanical, run it through the model and see how much stimulus you get, but it's the effect on confidence. And I think the new president can probably do quite a bit in that area, even apart from his stimulus package. So we'll have to wait and see whether he acts like Franklin Roosevelt. I understand he's been studying Franklin Roosevelt, so we'll see what he says.
Jerry, you've written an enormous amount on the history of capitalism and economic thought. What historical parallels do you find useful in terms of developing a long-term perspective as to how the system is going to evolve from here, given the political forces that have been brought into play?
Well, to go back to something that Michael Bordo said, but to restate it somewhat differently, the history of capitalism is the history of failure. The history of socialism is the history of failure too, but it failed sort of definitively because there were basic problems it couldn't overcome. History of capitalism is of the development of new institutions, new practices, and those institutions and practices turned out to have certain advantages, and they also turn out to have certain unanticipated or unintended disadvantages. And that then leads to a crisis that then leads to institutional reform, both in the sense of governmental institutional reform, but also on the level of companies themselves and of investor actions and so on. And I think that when we think in terms, historical analogies can be useful, and they can also be very dangerous, because in a way, historical analogies are like flashlights. They guide our attention to some aspect of reality, but they leave other aspects of reality in the shadow, so to speak. And nowadays, the historical analogy that's on everybody's mind is the Depression from 1929 on. And indeed, there's lots of things that we've learned from the Depression and the way that it was handled. In terms of monetary policy, we know the Fed then did the wrong thing. They contracted when they should have loosened. In terms of fiscal policy, we know that tax rates were kept high and even increased when they almost certainly should have been decreased, as for example, Keynes wanted. In terms of sort of ideological tone, there was a highly anti-capitalist ideological tone in the Roosevelt administration that probably played a big role in decreasing confidence and animal spirits, and we've learned from that too. So you don't see major politicians in Western countries speaking in anti-capitalist terms, even though you might think, based on the crisis of the system, that they would be. But I think there's a danger here, and that is precisely because this analogy of the 1930s is so much in people's minds. So they think in terms of monetary policy. What did they do wrong now? What should we do right now? What did they do wrong then? What should we do right now? I mean, Ben Bernanke spent a lot of his career thinking about precisely this issue. Fiscal policy, we now know that you shouldn't increase taxes at a time like this, that there should be some kind of a fiscal stimulus. What I'm concerned about, though, is I think that this may very well miss some of the key issues. And a lot of those issues have to do with what I've come to think of as a kind of crisis of epistemology in our capitalist institutions. That is to say, a crisis of understanding within the institutions themselves that are related to what you might call opacity. That is to say, an inability to see clearly what's going on and hence to understand clearly what's going on. I don't just mean on the part of government regulators or public policy officials. I mean, what's most striking when you look back on the past few years is that the people who are the key actors in our financial institutions, I mean the heads of big financial firms and so on, didn't understand what was going on. And they didn't understand largely, I think, for reasons that are sort of dialectically related to the innovations of the most recent era. So it's an era that put a great deal of emphasis on the virtues of diversification of investments, of diversification of firms, especially with the repeal of the Glass-Steagall Act that allowed then for much more multifaceted firms. Well, it turns out this was supposed to have certain advantages in terms of decreasing risk and so on. It turned out to have certain unanticipated disadvantages in terms of spreading risk. And then there was the supposed advantages of, and then the notion was if you diversified holdings enough into CDOs and so on, if you brought together enough kinds of assets, that would also decrease risk. That turned out to be dialectically false. And that is to say, it meant that you were bundling together more and more assets where you couldn't keep track of what was what. Even the people who put it together, and especially, of course, the people who bought these instruments, don't know to this day what's what. That is to say, what things are worth. The supposed advantages of more sophisticated financial instruments turned out to be so sophisticated that really nobody could understand them, not least the heads of the firms who were presiding over firms that were making investments where they didn't understand the nature of the risks involved. And that goes together also with a kind of fetishization of math, that if you have the math right and you have purportedly hard numbers, then you don't really need to know what the underlying assets are. So I think in many ways we have a kind of, as I say, epistemological crisis, a crisis of understanding in our major financial institutions. And in order to restore the confidence that people have been talking about, it's not just going to be a matter of monetary policy. It's not just going to be a matter of fiscal policy. It's going to be a matter of very substantial reform, both of regulation, but also very substantial reform by financial institutions themselves. I think the idea of having these very diverse firms, financial firms, investment firms, and so on, that are all part of one big firm, I think that's turned out to be counterproductive. And I think there may very well be a movement away from that. I saw this weekend that Citicorp is actually in the process of breaking itself up, precisely, I think, as a response to this crisis of understanding. The whole pay-for-performance business, where you have these numerical indices of how people are doing, creates tremendous incentives for gaming the metrics, as opposed to actually creating new useful things. So I think that actually, when you look at the historical analogies, there is a kind of danger in focusing on what happened in the seemingly most analogous situation in the past, because it may blind us or call our attention away from problems that are genuinely novel, or at least novel in their extent. And largely in the past, when you look at the history of economic crises, there's usually some underlying decline in the price of a commodity like land, or you have some kind of a bubble, and that then gets reflected in the financial system. I think what's so striking about this crisis, it's a crisis largely caused by the financial institutions. And so I think there needs to be a lot of reform, both on the governmental level and not least, though, on the level of the financial institutions themselves. And of course, in terms of people's investment behavior. Maybe you shouldn't invest in companies that are either too big or too diversified for the CEO to really understand what the hell's going on. If he can't understand it, maybe you shouldn't be giving him your money.
On that note, I'd like to open up the discussion to the audience. If you'd like to ask a question, wait for the microphone to come. Stand up, tell us who you are and what your affiliation is, and please try to keep your question as short as possible. In the back there.
Mish Bergeson from Landor. This is for Professor Shiller. There's a lot of wisdom around unlocking the housing markets as being the key to restoring animal spirits eventually. Can you talk a little bit about that, and specifically with reference to the initiatives right now between one of the big banks and legislators to get a bill passed to put the power back into the courts to renegotiate terms of foreclosures?
Well, the housing market, I think, is central to this crisis, and I don't know that it's been brought up, but the reason we are, of course, these financial system problems are important, but what was the disturbing factor? It was that got us here, and it was the bubble. We had actually twin bubbles. We had a stock market bubble in the 1990s, which peaked in 2000. Then it started up again after 2003 and crashed. So the stock market, in real inflation-corrected terms, has taken a 50% drop in value since 2000, which is not as big as the Depression, which was 80%, but it's very huge. So, and that was a bubble. It was excitement, overconfidence, and then a retraction from that. Secondly, we had a housing bubble. Home prices rose almost doubling between 1997 and 2006 in real terms. And once again, that was caused by investor euphoria, a sense that we're all going to get rich investing in housing, and a distorted thinking about there's a best investment. You should buy 2 or 3 houses. And it got people, it invaded our culture and changed our way of thinking. And we've pulled back from that. And now home prices are down over 40% in real terms in a number of cities. So that's the fundamental problem. The risk, I think it's correct that it's good in a sense that home prices are back down because they were elevated. High home prices are not what we want, but it's created all these problems that people are underwater. It's a fundamental problem. They owe more on their house than the house is worth. We have financial institutions who have exposure to real estate risk that they didn't manage. You're referring to one particular thing, that the bankruptcy law does not allow bankruptcy courts to adjust the balance on a home mortgage in a bankruptcy file. They can adjust other debts, but not the home mortgage. I suppose that's something that we ought to correct because I think that the problem that homeowners are in now is affecting our national psychology in a huge way. We're not doing enough for homeowners who are in trouble, and it's a classic case where we have a financial crisis that put people in trouble, and if we don't do, there's a question of what's fair and whether we want to have taxpayers pay for the mistakes of others. But I think that we have to do something for people who are obviously suffering for mistakes that were not mostly their own doing. And that bankruptcy law change is one of a number of things that ought to be done.
Mahesh.
Thank you very much. My career has been in structured
Can you tell
finance.
us who you are? And
Mahesh Kotecha, Structured Credit International. I therefore ask about innovation and opacity. We have complexity and all the math, and it's going to be very difficult, it seems to me, to unwind from that. What do you see as the unraveling of complexity and the restoration of simplicity, as it were? And is there really the prospect for that, having come this far?
I'd like to take that on.
I guess so. One way of diminishing complexity is by diminishing this, is by something like, and I'm not saying this is an exact analogy, but something like a new Glass-Steagall Act that would disaggregate various financial institutions into more and less speculative parts that would, so that if one part of the operation became overexposed in terms of risk, it wouldn't bring down the whole thing. I think in terms of the size of financial institutions, I'm a bit afraid that because people haven't been thinking enough about these issues of knowledge and complexity and opacity, that some of the things that have gone on really just in recent months may be counterproductive. The degree to which the Treasury has encouraged some big banks to take over other big banks, the degree to which they've encouraged more speculative sorts of institutions to take over depository banks to supposedly increase their leverage and so on. These may be exacerbating the problems of opacity and the problems of complexity. So I'm not sure what all the solutions are, but I think that some disaggregation of financial companies, both by law and by the inner motivation of companies and investors themselves, are probably in order. That having been said, I think I'm better at identifying the problem than identifying the solution, but that's at least further than a lot of people have gotten.
Dick, do you have any thoughts on the solution in terms of financial sector reform specifically?
Yes.
Yeah.
Yeah, I mean, we're bound to get some reforms. I mean, throw out a couple of ideas. Before the financial crisis hit, there was this discussion of, let's call it the Warren Buffett issue. Warren Buffett said, isn't it strange that in this country, I, who make, billions a year, pay a lower tax rate than my secretary who makes, $50,000 a year? And apparently there was this business about the gains of the hedge fund guys and that were taxed as capital gains rather than ordinary income. And I'm thinking about that now. You haven't heard anything about that for the last couple of years because there are bigger problems. But think about it as an incentive problem. I think this crisis, we ought to talk about the incentives of various people in the system. And, if you could really make a huge amount of money and you were taxed at a low rate, well, maybe you would take more risk to do it. You created an incentive. So maybe Buffett was right. I think he was calling for himself paying the same tax rate that his secretary did. Shocking. And I understand that when this idea floated, our wonderful Senator, Mr. Schumer, went to Washington and said, no, you don't. You want to keep the tax rates low on these guys earning billions a year. It's like Galbraith used to say, you have to keep the tax rates low on the rich people to give them proper incentives, but you need to keep them high on poorer people in order to give them incentives to work.
By the way, Buffett is giving it all away.
Yeah.
So
one more idea, though, Ben. One more thing. The other idea thrown out is, it's not original with me, but some of the, Wall Street had a big shift from partnerships to corporations. That has a lot of incentives. We should think about how the incentives changed when Wall Street firms became big corporations instead of partnerships. And I noticed that one of the really sage people on Wall Street, or his name is Al Wojnarauer, in one of his recent letters said, maybe the government, I thought it was shocking that he said this, but maybe the government should require Wall Street firms to become partnerships again, so they have skin in the game and it'll give them better incentives. Think about that.
Mm-hmm.
My name is Richard Weinert. There was a brief allusion to Japan in the various comments made. And I'd like to ask you, Japan, of course, had a major financial and economic crisis from the 90s. It has had major fiscal and monetary stimulus since without success. So I'd like to ask what lessons might be learned from that experience.
Michael? Okay. I think that Japan had a number of problems which are similar today. They had a banking crisis, and they had a period of close to deflation or mild deflation. The problems with Japan were that they didn't really address the issues of the banking crisis or of the deflation until it really dragged on. They didn't really deal with the banking crisis until 1997, something like 7 years after it started, when they started to move to what's called a good bank, bad bank strategy, where they pooled the bad assets and sold them off and then injected capital into the good. So they started doing that in 97. It actually did have some effects. And monetary policy, they were very slow in following expansionary monetary policy. Finally, again in the late 1990s, they followed this quantitative easing and they pushed interest rates to zero. And that actually did get them out of the deflation. Okay, they haven't really stimulated the economy very much, but they actually got out of the mess. Okay, and so what I learned and the fiscal policy, they engaged in massive fiscal expansion in the early 90s, government spending, which was only successful while it was going on. Okay, then they got worried about possible inflation and they started raising taxes. Also, the government spending, was largely on unproductive public sector projects, which didn't really do very much in terms of really affecting the productivity of the economy. So that's one lesson we should learn from Japan, not to repeat the kind of public sector spending they did, the types of spending they did. But I think the real problem with Japan is they didn't really follow an expansionary monetary policy early enough or long enough, that the policy of quantitative easing that they moved into and that we are now copying, actually is the way to get out of the kind of doldrums that they were in, and that you really need to reflate the economy. You have to just, in a sense, throw money at the economic system. And a lesson that I get from that is that when you have a banking system that freezes up, when bank lending freezes up because there are bad assets on the books of the bank, you go around the banking system. You buy assets that do not directly impinge on the banks. Okay, you buy corporate securities directly. You buy long-term government bonds. Okay, and this does work, and it did start to work in Japan. Okay, they didn't go far enough, but it did work, and that's the policy, I believe, that's really going to get us out of this recession right now. Okay, I'm an old-fashioned monetarist from way back. Milton Friedman was my thesis advisor in the 60s. Okay, and I really think that monetary policy is the key. Okay, and that is the Fed is what's going to get us out. And when the dust settles, okay, and this is like an episode in economic history, 10 years from now, and they're going to say, well, what got them out of the recession? They're going to say it was expansionary monetary policy. Okay, they're going to say it's the quantitative easing that they started in 2000, at the end of 2008, that really was set the stage for coming out of the recession.
Michael, can I keep you on this issue of monetary policy for a moment? Because history of monetary policy has been one of your areas of specialty. And in the 1920s, the Federal Reserve was dealing with their monetary policy responsibilities in a very perverse way. That were, in theory, they were following a gold standard, but gold was pouring into the United States, yet the Federal Reserve was pursuing a very tight monetary policy, and many economists consider that to be one of the causes of the stock market crash and then the Great Depression that followed. In the 1960s, we were on a gold exchange standard, but of course the U.S. was losing gold reserves very rapidly and just trying to cover it up by encouraging France and others not to cash in their dollars for gold. And many are pointing to monetary policy again as a root cause of the current crisis, particularly the very low level of interest rates that we had from 2001 to 2004. What are your thoughts on the role of monetary policy?
I mean, I think the environment that created the crisis, not the causes of the crisis. The causes of the crisis are in the financial system, okay, and in the subprime mortgage market, et cetera. And this has been discussed by a lot of people. But the environment that created the bubble, the first bubble, the stock market crash, that led to a stock market crash that Bob talked about, and the second bubble that was part of the first bubble, is expansionary monetary policy. The Fed kept interest rates low, okay, starting in the late 1990s and after the East Asian crisis and after the Russian crisis. They really worried about the crisis spilling over to the U.S., okay, and so they loosened. They tightened a little bit, but not enough. Okay, then after the 9/11 crisis, again, they thought 9/11 was going to lead to a major financial crisis. Okay, what they did was they loosened considerably, and they did not tighten until 2 or 3 years later. In fact, then the next problem was deflation, and they said, gee, we're going to have a deflation like the 1930s, or if not that bad, like Japan. We have to follow very expansionary monetary policy, and they did in 2003 and 2004. So this was the environment that provided the monetary expansion, that provided the credit, the easy access to credit that fueled the booms. First, it was the stock market boom, and then the housing boom. Okay, they started tightening, okay, in reaction to a fear of inflation in 2005. Okay, and in a sense, that was the tightening itself, even though it was very minor if you look at the data. Okay, that tightening itself was the trigger that led to the end of the boom. Okay, because all you need in the story of booms and busts is some trigger that makes the valuation, that leads to the bubble, that makes the valuation suddenly become clear to people that it might not work, and that leads to the sell-off and the crash. Okay, it was the tightening that started in 2005, okay, that created, that in a sense set the stage for the crash. But the real problem were the low interest rates in the early 2000s.
Bob, do you have any thoughts on Japan or monetary policy?
Yeah, I think that I wouldn't describe the fiscal policy in Japan as a failure. They did not have anything like the depression of the 1930s. Japan has continued to grow at a slow rate over this period, and it's kind of remarkable that they've done so well after having seen the bursting of these huge bubbles. And so I guess I have a different view of the world than Michael. You seem to put it all onto the monetary authority mistakes. And I'll grant you that they made mistakes, but the rest of us make mistakes too. And part of what goes on in these bubbles is in our own minds. And also part of what drives the monetary authority are the same mistakes that other people are making. So there was complacency in the Fed about the housing bubble, probably for the same reasons that the rest of us were complacent about it.
John.
John Beatty from UBS. One of the lessons we've learned from the current financial crisis is that intermediation of risk reduces the incentives for adequate risk management. In other words, so long as risk is intermediated from a mortgage loan broker to a commercial bank to an investment bank and to an investor, there's really no incentive at each stage of the game to have adequate risk management policies in place. In terms of overhauling or reforming the financial regulatory system, what policies do you think could be adopted to ensure that there are sufficient incentives in place to make each participant adopt adequate risk management policies?
Bob, you want to
So I just had a couple of quick things. One is the rating agencies were being paid by the people they were rating. Right. That was something John Moody, in his autobiography in 1934, said very clearly, you should never, as a rater, accept money. It's like professors accepting money from their students before grading them. You can't do that. And that's something that we have to fix. The other thing is that issuers of securitized mortgages should have more skin in the game. They're selling it off too completely. And so they didn't, we need to force them to take on more of the risk that would incentivize them to manage it better.
Can I push you on that question of credit ratings agencies? I think it's very easy to say that the issuers shouldn't pay them. I think that you can make a pretty strong argument that that's the case. But it's unlikely that investors are going to pay for it because, of course, as soon as a credit rating is issued, everyone can take advantage of it. So you've got a big free rider problem. And so if credit ratings agencies can't charge anyone for giving a credit rating, then why should they bother at all? In which case, should we even have such a government-sanctioned industry in the first place? Or simply declare that these guys are institutions with opinions, like you have an opinion, I have an opinion, the Wall Street Journal has an opinion, and let it go from there.
It's interesting that John Moody talked about this in his autobiography, too. When he set up Moody's in 1901, people told him, you'll never make any money doing that, for exactly the reason. And he did it out of some sort of mission, sense of mission, and he did all right. We had Moody's. They didn't start accepting commissions from the people they rated until, I think, long after John Moody had died. And so it is a model that worked. And now it may be a little different in the internet age, and there might have to be some financial innovation. I don't think it's simple and obvious to know how you deal with these agency problems. That's one of the things that we keep learning through time.
Dick, do you have any thoughts?
Well, these credit rating agencies sold like a newspaper subscriptions, like magazines. There was a free rate. The big difference was that I think if you go back and look at Moody's or S&P back in the late 1960s, I mean, they were companies, they were famous names, but they had 10, 20, 30 people working for them. I mean, and then they decided that, and of course, we got into an era where all kinds of securities were issued by more and more places all over the world. They changed the model from selling subscriptions, like like your Economist magazine or something like that, to this model of the guys who wanted ratings of their securities. They had to pay for them. And, of course, that led to a huge expansion of the business, created all these conflicts. The government made a mistake in the 1970s by dubbing these old raters nationally recognized statistical ratings organizations, sort of putting the government blessing on them. And then the whole world had to sort of get Moody's and S&P and Fitch to rate their securities. And then they started charging for it. It was a very lucrative business, and I think we got into this mess. So, I mean, the model can work, but one might say, why have these private companies? Maybe the government itself should rate the securities.
Yes, right here.
I'm Steve Friedman from Pace University. To what extent do you think the excesses in the system are powered by the compensation systems in the financial services industry, in which everybody, right down to loan officers, are compensated on the basis of revenues? And if you think that is a problem, is it a problem you think a regulatory system can deal with?
Jerry, you want to start on that?
Yeah, I think the answer is hugely. It creates all sorts of perverse incentives. It creates agency problems within firms, that is to say, of people creating and selling financial instruments that bump up their individual numbers or bump up the numbers of their subunit at the expense of the corporation as a whole. I think something that somebody already mentioned, that when major investment firms went public, in retrospect, we see that created all kinds of negative incentives. Counterproductive incentives. That is to say, incentives to manipulate the numbers by selling more and more stuff, regardless of the quality of it. That meant then you wanted to find some standardized way of claiming to objectively evaluate the stuff, right? So you had these very dubious mortgage lenders and so on, which was simply discounted on the notion that if you aggregated enough of these things together, these BBB properties, if you aggregated enough together and tranched them, you could miraculously create AAAs out of them. So I think that, yes, the compensatory system, and this may be a larger problem in American economic culture right now, the extent to which this was criticized for a long time under the rubric of short-termism, the extent to which the whole notion of shareholder value, that you're going to increase profits every quarter, and you're going to do it by all sorts of forms of manipulation, including not investing in human capital, including massaging the numbers, all sorts of ways of trying. if people are just oriented towards short-term investments, as opposed to what used to be called buy and hold investors. Are there still such things? Then you have a system where, in some ways, it created much greater liquidity in the market, and that's seen as a good thing. But again, sort of dialectically, this turns out to have a lot of negative consequences. So yes, I think in answer to your question, the existing compensation system is a huge problem. Whether that ought to be corrected by government or whether we will start to see changes within firms themselves, not, of course, in response to executives in the firm who are perfectly happy to be compensated that way, but in response to investors, pension fund investors, and so on. Maybe they will be the ones pushing for changes in structures of incentives because, by and large, it hasn't worked out very well.
Okay, I see a hand in the back. You, yep, right, you, yep.
Dale Ponick, Farm Millbank Tweed. Two causes which I don't think we've talked about that I would like to hear your views on. One is the dollar. Could this have happened anywhere other than in the United States? And then secondly, somewhat linked to it, international politics. Could this have happened without our policy towards China?
Michael, you want to start on that one, on the dollar?
Okay. I think that one of the causes that people have talked about, including the chairman of the Fed, for the expansionary environment that led to the boom, was the savings glut from China, which is part of which comes out of our international policy. And part of what Peter Garber, who's sitting in the front here, talks about is a new Bretton Woods system. So that created part of the environment. But I kind of think that most of the crisis was homegrown in the financial system, and that the dollar, in a sense, is sort of a byproduct of what's going on inside the United States. And so I think that the concerns that people have about the dollar depreciating as a consequence of this crisis are kind of beside the point. That in a sense, we want the dollar to depreciate to stimulate the economy. And I think the Fed is deliberately following this kind of a policy. And I think that the dollar is determined in a free market, and that when the economy recovers, the dollar will recover with it. And if we follow the policies we need to follow to stimulate the economy and stabilize it, that the dollar will fall into place, and that the reason that the Chinese and others have invested so heavily in the U.S. is because of their long-term faith in the U.S. system, and the fact that the U.S. is a good place to invest. And I don't see that changing, that long-term prospect for the productivity of U.S. capital changing much in the future.
Other thoughts?
Well, I think part of the story is the psychology generated by our perceptions of China. You know, they want to invest in us, and they are growing rapidly wealthy. It created a sense during the boom period of a world that's running out of everything. And I keep bringing up the psychology. That's part of it.
Thanks. My name's Ken Miller. What if the problem is not the rating agencies, the financial incentives, regulation, but this tendency of the capitalist system to overproduce goods and services? So you can do all these things. You talked about the New Deal not working and it taking World War II to get us out of it. And it's hard from an economic point of view to find a good war these days, in the days of nuclear weaponry. So what if that's the problem? Do you just have to wait it out until the animal spirits naturally rise again? Or does it take a war or something really big to organize the society around?
Who'd like to take that one on?
Well,
Jerry?
Shiller.
Well, under-consumptionist theories have been around since time immemorial. Already in the in the mid-19th century, people were saying what else could people possibly want to buy than the things we already have? So the capitalist system is overproducing. In fact, in Marx, he didn't really have one theory of capitalist crisis, but one of them was an underconsumptionist theory. Then at the turn of the century, you had John Hobson, who thought that imperialism was due to the search for markets abroad because the working class at home wasn't able to consume enough, and so on. And of course, during the Depression in the 1930s, it was an omnipresent theory that Schumpeter and others deflated. No, I think there's always a shifting horizon of new things and services and so on that people want to buy. The history of capitalism is the history of the creation of new wants that come to be subjectively perceived as needs, and that's not going to end anytime soon. So I don't think the problem is one of overproduction or a surfeit of production and so on. I think it has to do with all these other issues, but that's one I'm dubious about.
Let me take two more questions to close back to back. The woman in the fourth row, and then Peter in the fifth.
Thank you, Paula DePerna, Chicago Climate Exchange. Just to pick up on this last point, of course, one of the big ideas currently discussed is green jobs and retooling the energy system, smart grid, and so on. So one, do you think that that's a current big idea? And secondly, are we sufficiently wired? Are the policies sufficiently wired to lead to jobs creation? Or are we sort of going to put a little bit of money here, there, and the other so that we don't get this sort of big idea result? Thank you.
And Peter?
Peter Garber, Deutsche Bank. I can think of two states of the world, one in which there is not a generalized banking panic, in which market valuations are reasonably proper and market assets might be marked down and as bad news comes in, and another where there's a generalized banking panic and no evaluation formulas work at all, in which case all of the theories of finance fall apart and all of the rating agencies look terrible and the whole system looks like a disaster. And that seems to be what we're talking about, a generalized banking panic. Suppose there wasn't a generalized banking panic, as we didn't have until September, where market valuations look good, then we wouldn't be talking about these things. So the issue here is a generalized panic, and are you, in condemning all of these aspects of finance, thinking that we have a permanent generalized banking panic that we're not going to get out of?
Dick?
Well, quick answers to both questions. One, I think Peter's right. There are these two states of the world, and you know, a lot of the things that are going on now in this one, we should be glad, rarer state of the world are probably not things we'd want to do when the world was in the other state. So I agree with Peter that there are these two states of the world, and you know, nothing is good for every state of the world. There's some things that are proper to do in this particular state of the world to get back to the other state of the world. The other question was about the green investments and things like that. You know, there's some of us who think that's the next bubble. You know, Americans demand a bubble. The Onion says Treasury must create a new bubble for it. And maybe I think the next bubble might be in some of these green investments.
Okay, on that note, I'd like to invite you to join me in thanking our panel for an extremely stimulating discussion.
Thank you for watching this Council on Foreign Relations video. For additional audio, video, and transcripts of CFR meetings, as well as expert analysis of international news, please visit us online at cfr.org.